I am going to walk you through a transaction that almost didn't close, and then I'm going to rewind it and show you how it should have been structured from the beginning. Same property, same buyer, same market, two completely different outcomes depending on one decision made before the contract was written. Here's the transaction. Experienced agent, 12 years in the business, solid track record in the Denver suburbs. Her buyer was a software developer, self-employed through her own LLC for about 3 years. Strong income, $180,000 to $200,000 a year in distributions, consistent. Great credit, good savings, motivated buyer. They found the property they love. It was a $575,000 property, well priced for the area. The agent submitted the offer and the seller accepted. They went under contract. The agent worked with the same lender for several years. A good lender, someone she trusted, who had never given her problems on a conventional transaction. She referred the buyer to that lender. But 3 weeks into the transaction, underwriting came back with a condition. The lender couldn't support the income documentation because the buyer's tax returns. Those tax returns showed lower income due to business deductions. It couldn't be used to qualify him at the purchase price. The application as structured was going to be declined, and they had 11 days left before the financing contingency deadline. The agent called me on a Thursday afternoon. I looked at the file that night. The buyer's tax return showed net income around $95,000 after deductions. On a conventional loan, that's what qualifies him. At $95,000 of qualifying income, his debt-to-income ratio did not support a $575,000 purchase price. But his bank statements told a completely different story. Business accounts deposits average over $17,000 a month over 24 months. Personal account deposits consistent. The business was performing exactly as the buyer said it was. The tax return just didn't show it. So we pivoted to the bank statement program, looked at 24 months of business bank statements with an expense factor applied, produced a qualifying income of approximately $148,000. That income supported the purchase, so we submitted a new application on Friday, got a conditional approval by Wednesday. The financing contingency deadline was extended by mutual agreement, and the seller's agent was cooperative once they understood what had happened. We funded 19 days after the pivot. The transaction saved, but the agent spent 2 weeks managing a crisis that should never have existed. Now let me rewind. Here's how this transaction should have looked like from the beginning. Before the buyer ever found a property, the prequalification conversation should have included one question. How do you take income from your business? The answer, distributions from an LLC, immediately signals that this is not a W-2 borrower. Tax returns will likely understate qualifying income. A bank statement program is probably the right product from the start. That conversation takes minutes, but it can change the entire approach before any offers are written, before any seller relationships are established, before any clock starts ticking. The buyer gets pre-qualified on a bank statement program with the income that actually reflects his business performance. He goes under contract with the right financing already in place. Underwriting doesn't surface any documentation issues in a week 3 because the bank statement program was specifically designed to handle exactly this buyer's income profile. The agent doesn't manage a 2-week crisis. The buyer doesn't spend 2 weeks anxious about whether the deal is going to survive. And the seller's agent doesn't have to agree to a contingency extension on a deal they thought was solid. Same buyer, same property, same outcome, but without the stress, the scramble, or the timeline risk. The only difference is one question asked earlier in the process. You know, the agent in this story is not someone who made a careless mistake. She's experienced. She did what most experienced agents do. She referred a buyer to a lender she trusted who had always worked well for her transactions. The gap wasn't trust or confidence. The gap was product knowledge. Her lender was excellent at conventional loans and didn't routinely work in bank statement or non-QM programs. But this buyer's profile needed a different tool. The question every agent should be able to answer before referring a buyer to a lender: does this lender have the product my buyer actually needs? That question is the one that separates a smooth transaction from a 3-week scramble. One question at every buyer's first conversation: how do you take income? W-2, 1099, business distribution, rental income, retirement income, capital gains. The answer tells you immediately what documentation category you're working in and whether your lender has the right product. If the answer is anything other than a straightforward W-2, bring me into the pre-qualification conversation before the buyer starts shopping. Not because their situation is a problem, but because the right product from the start is significantly better than the right product after a 3-week scramble. Schedule a call at teamaronheim.com for realtors or text me at 303-596-9077. Every agent I work closely with has their own version of this story. A transaction that got harder than it needed to be because of the product mismatch that could have been caught earlier. If you want a lender in your corner who catches the mismatch before you're under contract rather than after, that's a conversation I want to have. You can reach out to me at teamaronheim.com for realtors or text me at 303-596-9077.